Anyone can buy stocks, but few people can figure out the best time to sell a stock. Sell your losers, let your winners ride, don't catch falling knives, be greedy when others are fearful. While these platitudes sound wise on paper, they're certainly not very actionable. Today we'll tell you why we sold a stock that's presently outperforming the S&P 500. But first, let's talk about the importance of having rules. An entire discipline has cropped up around investors who behave irrationally, and it's called behavioral finance. Now, you can take emotion out of the equation with a rules-based approach. So, there's, for example, 2 reasons we exit tech stocks. The first reason would be revenues stop growing, so the company's not capturing market share. They're not disrupting. They may even be being disrupted. And the second reason is if the thesis changes. So a classic example of that would be on-demand manufacturing. Now, both of these rules are clearly very subjective because this domain is difficult to navigate and volatile. Now, when it comes to dividend growth stocks, the rule to sell is a whole lot easier. We exit a dividend growth stock for one reason. That's if the dividend stops growing. Now, in addition to these rules, we also sell or trim stocks to keep our portfolios balanced. This helps take profits off the table for both strategies. Now, you're never going to buy at the bottom and sell at the top. So this is a nice set of rules that helps you sleep well at night. So just to set the stage here, we have a 30-stock portfolio of dividend champions. Selecting those is largely objective using a Q-score ranking system that we've developed over the past decade. Now, our portfolio itself was built over decades using dollar cost averaging and DRIPs. It's the way you should do it. Now, the only reason that we'll exit a stock is if it stops increasing the dividend, but we will trim a stock if it exceeds a target weighting. So when it comes to trimming, here's what we've mentioned about this topic in the Quantigens report. So high flyers that start to exceed the 3.3% target weighting we've established will be trimmed. Now, how did we arrive at 3.3%? Well, you simply take 1 and divide that by the number of stocks in your portfolio to get the target weighting of each. In our case, it's 30 stocks. 1 divided by 30, you get 3.3%. Now, this trimming activity is an exercise that provides us with extra income, if we're looking for income, or cash flows, and it takes a bit of money off the table, and certainly not enough to trigger any major tax implications. But we're considering making these trimming rules purely objective so that all emotion is removed from the process. And historically, we've been trimming at above 5%. So if a target position of 3.3% exceeds 5%, then we'll start to think about trimming it. Right now, that process is ad hoc. So I look at the portfolio a couple times a month and I'll note weightings. I'm always interested in lowest weights. These represent possible value traps, or highest weights. These are possible runners to trim. Anything exceeding 5% during that check-in is noted, and we'll trim the next check-in or so. Now, we don't alert premium annual subscribers on these trades because I don't think it adds any value at all. It's completely rules-based with zero subjectivity. It's simply the process of keeping our portfolio balanced, and everybody will have a different set of constituents that they're dealing with. The money from trimming is redirected to lower weighted holdings. And that brings us to the topic of the day. We recently trimmed Aflac as it approached a 6% weighting in our dividend growth investing strategy. Now, before we get into talking about Aflac, just a public service announcement. We're going to be doing 2 videos a week going forward instead of 3. Our aim there is to increase the quality of each video by 50%. And once we get past the summer holidays, we hope to put that into motion. We're always going to try to split topics evenly between dividend growth investing and tech investing, as we've always done. And things we'd like to examine on the dividend side, I think, that need exploring through the remainder of this year. What characteristics do fallen champions share so we can avoid investing in those, right? Or at least selling them before they decline too much. What can declining Q scores tell us about quality? That's particularly interesting. Can we then start to predict when a champion's about to fall? And if we're able to do that, we could certainly possibly generate additional alpha in our strategy. Now, the other thing we'd like to do is cover all 30 stocks in our DGI portfolio. At some point, we've covered a fair number. But let's talk about one in our strategy now, Aflac. So Aflac is up 83% in 2 years versus Nasdaq up 64% during the same time frame. You can see here the recent spike. Now, we'd expect to see fundamentals that justify this price appreciation, and indeed we do. Here you can see earnings per share seeing nice growth over time. That's the chart on the left, 4% growth for Aflac's net income. Now, on the right, you see a chart that shows their earnings per share growth. So if you took all their profits and you divided them by the number of shares, earnings per share, this is that respective growth. It's growing at 8%. So how can their earnings be growing slower than earnings per share? And this is clearly a case where the number of shares is decreasing so that the amount of earnings each share receives is greater over time. Here you can see that with dividends and share repurchases for Aflac. Now, because share counts are going down every quarter, that's boosting earnings per share, and that helps accelerate dividend growth. So you see here, when we think about a payout ratio, it's very clear based on just this data here alone that Aflac has a very low payout ratio, which we like a lot. That gives them a lot of buffer to raise that dividend over time, and indeed they have. So on the top here you see a yield chart, 1.84% yield. So not a whole lot, though it's enjoyed higher yields than that. You see it touches on 3 every once in a while, and then there it looks like during the crisis it breached 4%. Now when it comes to the growth of the dividend, that's what's most important to us. And along the bottom there, you can see the growth, rather sporadic but exciting. So I noted, at least in the past recent history, several large raises, 18% and 21%. And when you're watching your income jump like that, it's certainly quite exciting. You can see the various growth rates here. So a 10-year growth rate of 9% is certainly above. I think our average is around 8% in our universe. So that's decent. And because they have that buffer for payout ratio, we'd certainly expect to see additional increases going forward, especially when share prices are increasing, so buybacks may not be that attractive. So what does Aflac do? Well, they take a whole bunch of money from people who buy insurance. That's called a float, right? They put all that money on their books. 56% of it comes from the Japanese, 38% from the Americans. So it's certainly an international business. They then give money back to people who paid them for insurance policies when required. The idea there, of course, is to give back less than you received. That's about using big data to better underwrite more profitable policies over time. As a market leader, they enjoy a data advantage. We love investing in market leaders. They're the #1 provider of cancer and medical insurance in Japan and the leading provider of supplemental insurance in the United States. Now, they should be, one would hope, using data to write better policies and investing their float to generate returns. So Warren Buffett loves insurance companies because they get to do this. They take all this money that's sitting in their books, they can invest it, enjoy a return on it. However, we would like to see low risk. The last thing that you want is a insurance company that's out there taking a whole bunch of risk and not having money to give back to people who make claims. And in this case here, we see most of Aflac's money that's invested is in fixed income of a high quality, as you can see. But part of this segment, I think, shows why you need to be careful here. So if you see the other here, anything that's not fixed maturity security, so anything that's not blue in the left chart there, a component of that would be Aflac's commercial real estate loan portfolio. So it's 7.5% of their exposure, not a whole lot, but you see the notes here, office market struggling nationwide and return to office, etc. Total of 15 foreclosed properties with carrying value of $500 million moved to real estate owned. So they had a loan out for a particular property and the person couldn't pay it, so they possessed that property. They realized a loss during the process. You see here, foreclosure watch list of $1 billion in active foreclosure proceedings. Well, let's say a watch list of $1 billion and $206 million in active foreclosure proceedings. So that's a decent chunk of this overall portfolio. They talk about taking ownership of these properties and managing through the cycle and maximizing recoveries. Well, let's certainly hope so. This is why you don't want a firm that has liabilities to be taking too much risk. Now, one thing to note about Aflac I find interesting is that if you look at the life expectancy of countries around the world, in first place is my home, the place I love dearly, Hong Kong. I can see why it's in number 1 position. It's just a great place to live. Number 2 position, Japan. So the longer that people live, the more health insurance they consume. So it seems like that wouldn't be a very good geography to be selling health insurance into. However, because people are living longer, they're leading more healthy lifestyles, which means that you may not have to pay out that much in claims. They may just die of old age. Now, since you asked, you're probably wondering which countries have the lowest life expectancy. This is rather interesting. Places that you don't really want to visit, although I've been to several of these countries. There's some of the fastest growing populations in the world represented here. I was shocked to see Nigeria with the lowest life expectancy in the world, and it's the 6th largest country. Rather interesting. So we get back to Japan. They actually have a declining population, so that's a declining total addressable market. Look at that, how that peaked there and it's starting to decline. I know this chart shows to 2017, but I think their population is somewhere around 125 million right now. So it's very slowly, steadily declining over time, and they've probably reached peak distribution. You look at their latest investor deck here, you can see that just about everybody's peddling Aflac life insurance policy. So the average customer in Japan holds a policy for about 20 years. So these are some great recurring revenues. Here you can see cancer, a big component of Japanese premiums, whilst cancer isn't one of the leading causes of death in Japan. And that's a good segue into talking about a market where they might be able to expand more. You see Aflac U.S. Financials update here, their earned premiums. And when you look at these types of insurance policies, they all fall under this umbrella, U.S. Worksite Supplemental Health Insurance. And this is interesting. Aflac is a leader with 3 times greater market share than their nearest competitor. That tells you the market's very fragmented, this supplemental health insurance market, and it's where people purchase additional insurance on top of what their workplace might provide. Things like perhaps vision or dental. And here you can see the growth opportunity in the U.S. for Aflac. Certainly, they should be investing in trying to grow this, and you would see then the ratio of Japanese revenues to U.S. revenues decreasing over time. And you could see here the number of employers that allow access to Aflac and then the people that take them up on that. So when it comes to selling Aflac stock, we sold 11.5% of our positions. We indeed did sell the stock, but we didn't exit the position. That particular position's held at a transfer agent, so selling in blocks is more efficient. Otherwise, we typically use reverse dollar cost averaging, so selling a little bit every day until the position's back where it needs to be. Brokers ought to set that feature up because it's quite laborious to do that. We reinvested in several lower-weighted names. I don't think that's important information because it's, again, largely objective and relative to our own cost basis on every holding. And when it comes to that reinvestment, you can just simply look at the lowest weighted positions, but beware of value traps. So, for example, I think the only name we're holding right now with some concern would be Franklin Templeton. So stay tuned for additional info on that. Now, concluding thoughts on Aflac. Share price is increasing, which makes buybacks less desirable. So those buyback dollars might go towards growing through acquisition, perhaps, that U.S. supplemental insurance market, which is very fragmented. They have lots of choices when it comes to firms they can acquire, and those that they do can benefit from big data. Speaking of which, they need to talk more about how they're using data and technology as a competitive advantage. And when we look at the Japanese franchise, we'd expect that to decline over time. But what sort of adjacent offerings could the Japanese use that Aflac might consider offering? Now, to touch quickly on trimming DGI stocks, if you're looking for a rule, let's say you have a 30-stock portfolio, here's what you can do. You can put a stock on watch at 5% weighting, and then you can wait until it exceeds perhaps 5.5% or upwards. Then you can trim it back to 5%. As I said, using reverse dollar cost averaging. This creates cash flows in a closed portfolio, which is really nice because you can either spend that money as income or reinvest it in lower or lowest weighted holdings, as I said. Now, your portfolio may have 10 or 20 stocks, and you can just create your own rules. It's not really important what those parameters are. Just have rules and follow them. Maybe your rules you never sell. That's fine, too. However, we believe this rebalancing creates alpha, and our paper on performance of our Quantigen strategy shows that rebalancing over time creates alpha. And along the bottom here, I've put the highest weighted positions in our portfolio. So you see Aflac is still around 5%. We'll give that a while. Let it sit there and think about what it's done. Then you have Parker Hannifin. We did a piece on them recently and talked about trimming them. And then IBM has had a little bit of a run lately, and that's why it sits up there. So if you're interested in building your own dividend growth portfolio, it certainly works very well, the strategy over time. Then I'm going to put up this video that shows you just how to do that. Please make sure to subscribe to our channel for more dividend growth investing videos. Thanks so much for taking the time to watch this today.